Mark Zandi, Moody's Analytics chief economist, joins us now. How do you view the net effect of the Trump economic policies?
Negative. If I were going to answer that question about markets and the economy, I'd say his policies would be good.
Is it because you're a Democrat, Mark?
No, I'm an economist. No.
Okay.
But I was going to answer it this way. So this may change your question. I think he's good for the market. I think he's good for the stock. The policies are good for the stock market, right? Because corporate tax cuts, goes right to shareholders. Less regulation, obviously that's helping financial stocks and fossil fuel stocks, utilities, and more M&A, mergers and acquisitions. That's good for stocks. So I think his policies are good for stocks. I just don't think they're good for the economy. I think the economy is going to be diminished by broad-based tariffs. That I think is settled. I don't think there's any debate there. It just depends on how aggressive he is in raising tariffs on whom and for how long. And deportation is not good either in the current context if they're broad-based, because the labor market's at full employment. You ask people to leave the labor market, you're going to tighten it and create more inflation. By the way, Sarah, I think the bond market reflects my views that the 10-year Treasury yields up a full percentage point. A lot of reasons for that, but a key reason is higher inflation expectations, higher term premium because of higher deficits. So I think bond investors are on the same page that I'm on.
Well, it could also be, though, a reflection of better economic growth prospects. And you sort of throw out deregulation, but there are others. We talked to David Zervos of Jefferies here a few days ago, who says markets underestimating the powerful growth impact on deregulations. This is a president who ran on a pro-growth agenda and has put people in place, all from the business world, who know how to grow.
Yeah, I'm skeptical. Look, you show me one academic study, any study that has been able to connect the dots between regulation and macroeconomic conditions and growth. It certainly helps if you have less regulation. Certainly helps those sectors, certain businesses. But from a broader macro perspective, in terms of jobs and GDP, I haven't been able to connect those dots, and I haven't seen anyone else connect those dots. And talking to you as a business person, so I run a business as well. I have a couple hundred economists around the globe. We have a business. For me, what matters about regulation is that it's clear. There's a bright yellow line. I know exactly what the regulation is. And please don't change those regulations, because once you do, you make life very difficult for business people. So the regulation matters, but what really matters, I think, to most business people is give me a clear, transparent set of regulation and don't change them.
Why did the Federal Reserve cut rates by 0.5% in September, Mark?
Well, they should, Brian, because they achieved their mandate, right, with full employment, 4% unemployment rate, check. Inflation back within spitting distance of target, and all the trend lines look good there. It's not coming in quite as fast as everyone would hope for, but it's coming in, and it'll be there. So you've achieved your goals. Therefore, the federal funds rate target, the key interest rate the Federal Reserve controls, should be at the equilibrium rate, that rate at which it's neither supporting or restraining economic growth. That was not 5.5%. That was what it was back before the September rate cut. If you tell me it's closer to 4%, where we roughly are today, I'd say, okay, that sounds about right to me. It's an empirical question. We'll have to see. But 5.5% is not the right number. So why take the chance of undermining the financial system and the broader economy with a 5.5% funds rate target when you've achieved your goals? So that was the reason, the logic behind cutting rates. And I think it was a sound logic.